Good morning, everyone. Thank you for joining us for the April Business Series. We are allowing everyone in from the Green Movement Room, and we'll start in just a moment. I called it the Green Room, not the waiting room. That sounds more elegant. Okay, so we are right at 8:30. Once again, thank you, everyone. Good morning. Thanks for joining us for the April Business Series presented by PNC. My name is Elaine Bonneau, and we are really excited about the topic and the information that we're going to share with you today. But before we get started, let me start by saying happy Earth Day. Tomorrow is Earth Day. Early happy Earth Day to you. I hope that you'll do something green, although it's going to be cold tomorrow. I was going to say plant something or, do something eco-friendly. And a big thank you to everyone who came out this past weekend for Go Green in the city in downtown York. It was just a really exciting day. So I just want to thank all of the attendees, the business owners, our sponsors, UPMC, York County Solid Waste Authority, Heritage Valley Federal Credit Union. We could not do it without you. And of course, our volunteers and our awesome team at the YCEA. So thank you all for a great day. Couple things that I want to talk about before we get started for today, upcoming events. So the Women's Business Center organization, also referred to as WBCO, is planning a business summit this summer. And we are interested in knowing what it is you would like to talk about and learn more about. So if there's anything that's on your mind that you'd like us to incorporate in the workshops for the business summit this summer, please just drop it in the chat. And we will make sure to take account of that in our planning. And also, if you want more information on that as the event develops, you can go to yceapa.org, yceapa.org, and find information. And also more information about WBCO in general. I was sharing with someone a women's networking group at York College of Pennsylvania recently. And one of the ladies who's new to the area said, how do I get connected with local women, professionals, women and business owners, and find a mentor? And WBCO was the first group that came to mind. They are so invested, women helping women succeed. And just great energy and positivity. And it's open to everyone. Gentlemen are certainly welcome to join the conversation as well, but just an all around great group. So before we get started, just a few quick housekeeping items. Everyone is on mute this morning. Again, thank you all for joining us. But you can certainly drop questions or comments in the chat or Q&A feature along the taskbar, and we will answer them. We're going to put aside at least 10 minutes at the end to answer questions, but certainly if something comes up that's relevant as the speakers are talking, drop that in the chat and we'll try to address those along the way as well. If you are experiencing any issues hearing the webinar, try dialing in through one of the telephone lines that was in the registration confirmation that you received. So, on to today's topic and our presenters. Today, we're talking about succession planning, selling, partnering, creating a successful exit strategy. And we really wanted to elaborate on that. I think a lot of times people think of succession planning in a very lofty way, like I must find someone to take over my empire. And we know that for most small business owners, that's not necessarily the reality, but you've worked really hard to build your business. And whether you're trying to grow that business or you're looking for investors, maybe you want to sell your business to start something new or retire, or you're dealing with an unexpected life change. And let's be honest, as we all know, this past year and a half, life happens. And sometimes we have to make a pivot. And so all of this really, succession planning is all about planning for the next stage of your business's growth and life. And so we have experts here today to give us some great advice on succession planning. And I'm going to turn it over to them. But first, if you allow me just to tell you a little bit about our speakers. First, we have Margaret, goes by Mieke. We all know her as Mieke Driscoll. She's a shareholder, education, and business law chair and attorney for CGA Law Firm. Mieke focuses her legal practice in the areas of business and corporate law, real estate law, municipal law, and nonprofit law. She is a shareholder with CGA Law Firm and serves as co-chair of the Education Law and Business Law groups. As a graduate of Dickinson School of Law, Mieke brings a great deal of experience in both law and in life. She was raised in York and is a graduate of York Catholic High School. Mieke has always actively supported various community efforts and programs. Her strong ethic of service to others extends beyond her community to her clients as well. Prior to law school, Mieke dedicated a year of her life to full-time volunteer service with Holy Cross Associates, a postgraduate program that offers participants the opportunity to integrate their faith through service, simple living, spiritual discovery, and community action. So thank you, Mieke, for joining us. And we'll also hear from Grace Quartey. Grace will round out our conversation with some really practical application from an accounting and tax perspective. And these are things that you, as a small business, can be doing on an ongoing and consistent basis, so that when you're ready for that next stage of succession planning, you have things lined up appropriately, and also some advice for those different stages that Mieke is going to outline. Grace is CPA and principal at Grace and Associates. Grace has over 26 years professional experience as a certified public accountant in both Maryland and Pennsylvania. Her background includes working as a compliance auditor for the state of Maryland, a financial consultant with Smith Barney and York, PA, serving as comptroller for a nonprofit organization on the Eastern Shore of Virginia, and as an accounting analyst with the County of Accomack. She also co-founded the nonprofit Building Solid Foundations to help develop rural Ghana in West Africa. I'm going to go with you one day on one of those trips to Ghana, and I so look forward to that, Grace. Grace previously served on the board of directors for the York City Business Improvement District Authority. We were so proud to have you as part of our board, and we don't let our board members go. So Grace recently joined the YCA board as on its executive committee, assuming the role as the organization's treasurer. So welcome to you both. We thank you for joining us. And with that, I will turn it over to Mieke.
Hi, good morning, everyone. Thanks for that great introduction, Elaine, and I'm excited to be here with everyone. I want to make a special thanks to Grace for being here. Specifically, it was my request that she join this call, because I think the accounting input is so important to this conversation. But as you all know, this is really a terrible time to ask anything of an accountant. So I am very pleased that she's joining us here, and I promised her that I would do most of the work, but I'm really glad to have her wisdom on the call here today. So before I get started and jump in with the PowerPoint that I had, I want to say first, feel free to ask questions at any time. We'll be monitoring those, and if they're timely to what I'm talking about, I'm happy to kind of take a detour and ask any questions as they come up. If it makes more sense to take them at the end, then we'll go over all the questions at the end. But I want this to answer the questions that you have. Business succession planning generally is kind of one part estate planning, one part legal planning, strategic business planning, and tax planning. So it involves a lot of different elements. And because every business is different and every industry is different, there is really no one-size-fits-all kind of plan when we're talking about this. So for anyone who is hoping this is going to be a how-to, it's not really going to be a how-to, but it's really going to highlight the kinds of issues that you need to think of when you're thinking about business succession, and some of the tools that you can implement to get there, and the professionals that you're likely going to need to involve to be able to do it successfully. It also takes a good deal of time and work. And I know it's often said that it's very difficult when you're working a business to take time to work on the business, but that's what this kind of work is. So you have to be very deliberate and intentional about it, and strategic in your decision making, and intentional about having important conversations that are sometimes difficult conversations with the right and important people. So with all of that background, I'm going to pull up my, okay, and change the view here. Okay, hopefully that can be seen by everyone. So we're take it right to this slide. So you've worked hard to build your business and it's working, and now you're thinking, what happens next? How do I keep growing this business in order to position myself to pass my wealth on to perhaps another generation, a key employee, and what's my, as Elaine said earlier, what's my exit strategy? I think another really important element to business succession is you're planning for the long-term inevitables that either one day you're going to stop working, either by choice or necessity, but also what becomes clear as you get into planning for succession is that you're also planning for the unexpected, which can happen at any time. And as Elaine said, if this year has taught us anything, it's to expect the unexpected. So you want to start considering what are the long-term goals for passing along your business or your wealth. If you want to grow your business, if you're looking for investors to inject capital, if you're looking for a family member to take over, perhaps a key employee, maybe you're looking to sell your business to provide cash for you to ultimately enjoy your retirement. It's a part of your retirement plan to position your business to be able to sell it. Securing retirement income, which can come from a number of sources. And as I said, the unexpected, disability, death, crisis. It could even be a considerable change in the market in which you work. You need to start asking yourself these kinds of questions too. What would happen right now in the event of a sudden death or disability of a business owner or a key employee? Both what would happen with control of the business, but even on a day-to-day, who's going to make the decisions? Who has the information and the know-how to carry on the business if an owner or key employee is not there? Another really important question is, how's the business going to be valued? If you're talking about if you're talking about looking for investors, if you're talking about selling to a key employee or another third party, if you're talking about how the business is going to be valued, if it is being inherited and passed along by will or other document. You also want to think about the legal and tax considerations of the transfer or sale of business. Depending on how you're making that transition, there's different legal and tax impacts that are really important to consider. Are there estate, inheritance, and gift tax planning strategies that are going to help you to reduce or defer your taxes in the long term? And for a lot of folks, particularly if you're in a family-owned business and maybe one or more of your children is also involved, how do you equalize inheritance if some children are participating in the business and others are not? And there's no one answer. Every business is going to look different because your industry is different, your situation's different, the key people that are involved are different, and so might your goals be different. But once you identify what your goals are, it's time to start thinking about the strategies and planning that are going to help you achieve those goals. Some additional important questions. Are you ready to discuss this? I think as with estate planning, these can be really difficult conversations to have, and you have to carve out the time to have them and be very intentional about having them. And setting aside that time to have difficult conversations is challenging. But I would suggest to you that the earlier you start, the better. The earlier you start thinking about these things and planning about these things, even if it's taking very small measures that build to an ultimate complete plan. There is no time like the present. It is never too soon to start thinking about what happens next. Another important question, do you have enough money for retirement? If you are just assuming that, that you're going to be in a position where you have either saved enough or your business is going to be, you're going to be able to sell your business in a way that gives you the kind of money that you need for retirement, that's not going to happen unless you plan for it. So you've got to start thinking about whether or not what you're doing now is setting you up for retirement. And there's a number of different ways you can go about that. Again, what happens if something happens suddenly? How is your business structured right now? For example, if you are operating as a sole proprietor right now, but your intent is to pass that business on, either because it's your legacy and you want to pass it on to family members or key employees, or because you need to put it in a position where you can sell it, and that's going to be your nest egg in your retirement. Either way, if you're a sole proprietor now, you likely want to think about forming an entity because that makes it a bit easier, A, to sell, or B, to pass on to more than one person, bring in an investor, that kind of thing. Another important question is, who makes the decisions? If there is one person running the show and making all the decisions, what happens when the unexpected happens with that individual? Are you setting other folks up to be able to make decisions in your absence? Do they have the right contacts? Do they have the right know-how? Do they know where all the important documents are? Do they know the passwords to the computer? Some of these things are big picture, and some of these are just really practical. How do I hand over the keys in case of an emergent situation? No time like the present. You've got to take, as I said, consistent steps to get there. It's not going to all happen at once. You can start these conversations and continue to have regular conversations. As a very practical measure, sharing contacts, information, plans, operational information, and involve your professionals. That's very important to do. Your legal advice, tax advice, very, very important to involve your professionals. And also, and this can be very difficult, and I think this is why this conversation about succession planning can be difficult to have, is that you have to prepare to let go. And that can look like a lot of different things. You have to perhaps prepare to retire, or perhaps you're growing at a rate where you have to prepare to let go of some of the control, because you're not going to be able to grow your business and bring in other key people to help you run it if you're not prepared to let go of some of that control too. That can be very difficult for a number of reasons. So I want to talk a little bit about family succession specifically. And obviously this won't apply to everyone who's on this call, but oftentimes we see family businesses that are growing and thriving, and you're looking at the next generation and how may family members be involved, and how you may make the business a family legacy and successfully pass it on from one generation to the next. And I'll say oftentimes family succession is a little bit of a blend. Sometimes you've got family members who are involved and not involved. Sometimes you have a combination of family members and key employees who are going to continue to carry on the business when you retire, step back, and or start sharing leadership roles. So there's two elements, I think, here of what you want to pass on. The first is the leadership, and you may be looking at who has the skills, the interests, who has the respect of employees to take on take on leadership roles, and it may be someone who's not in the family. So how you are setting up the next generation of leadership is one element of achieving family succession. And the second element is wealth. And this becomes where estate planning also becomes very important, an important part of business succession. And the questions you're going to ask are, am I dividing my wealth equally? If one child is heavily involved in the business, how am I providing for other children in different parts of my estate planning if my desire is to pass on my wealth equally to my children? One tool to sort of avoid that question is that maybe perhaps you've got a child who works in the business and one or several other children who don't. You can set up a system where the child who's in the business is actually buying in. So it's not a gift, they aren't inheriting it, but they're going to buy their way in to the business. And then so the rest of your estate planning remains equal. And it can be a combination of all of those things, but you need to start thinking about long-term, what is this going to look like? And will likely need to be revisited every 5 to 10 years or so to make sure that that what's happening with the business long-term is going to match what your long-term estate planning goals are. And in addition to family succession, you want to think about key employee succession. And we see this a lot where there's not a family member who's going to take over a business, but there is a key employee that's positioned to become an owner. And if that's the case, passing on the leadership and the wealth of the business can look very much the same. It's important to groom that leader, to share information with them, to increase their responsibilities, to make sure that you've got buy-in from the rest of your employees about who will be taking over leadership roles or parts of leadership roles. And then you can look at how to structure it so that person can ultimately buy in. And there's two ways to do that. And I think I have some slides that touch on this later. One is where an employee might actually be buying into the business. And that can be done incrementally. They buy so many interests a year. It can be done all at once, and then that employee perhaps, if they don't have the cash to do that, they have a long-term note with the company where they're continuing to pay that back. Or interest can be given either incrementally or in large lumps as compensation. And when that happens, that has to be valued for tax purposes. If you receive interest in a business in compensation for the work that you're doing for the business, that is income to you. It has to be reported as income to the IRS. And that's where valuations, which we're going to get into a little bit, become very important, because you have to have an idea of what the value of those interests are in order to report it as income. So this slide is a bit repetitive, but either way, you've got to formulate a plan. Have the successors been identified? If they have, then you need to groom them both with training, the skills they need, whether that's leadership training, whether it's industry-specific kind of training. And they also need the knowledge of the business. What are the important literal and figurative keys that need to be passed on to an employee in order for them to be positioned to successfully transition leadership. I would implement early. If you've got a long-term plan, I wouldn't wait until the 35th year for that employee to be in a leadership position. Let it happen incrementally over time, and that will assure a successful transition. And use your professional advisors, as I've said, and it's going to take time and effort to do that. There's a question here, I just opened it, about whether it's necessary to have a business prenup when planning, and what will it entail? The answer to that is absolutely yes, and I will talk about that. What a business prenup is really your governing documents of your entity. So whether you are a limited liability company and you've got an operating agreement, or whether you are a corporation and you've got a shareholders agreement, you absolutely, if anyone is buying into the business or is in ownership with you, or if they will be investing, it is absolutely essential that you have governing documents that outline the relationship, including how interests will be transferred and when, how those interests will be valued, what happens upon death or disability, and who makes decisions. And how that may change over time as well. It is completely essential. So we get right into the next slide. Tools for passing your business on to family or key employee, and I will add, or to an investor. If you're outright selling the business, you're not going to care so much about what the governing documents say when you're gone. But if you're bringing in an investor that's facilitating a transition over time, then the governing documents are absolutely key. If you don't, as I said earlier, if you don't have an entity already, if you're operating as a sole proprietor, then you need one in place, is my opinion, in order to have a successful transition plan. So that's one tool. Those governing documents are very important when you're talking about other folks, whether it's family or non-family, becoming owners of the business. You can also pass your business or wealth onto your family through your estate planning, through your will. You can create a business trust during your lifetime, and whether or not that will work in your specific situation will very much depend on the nature of the business, the kind of wealth that we're talking about, or the family members that may be involved. I would also say that in all of this conversation, I'm going to talk about this in a little bit more detail. Life insurance is a very important tool. I would actually say life and disability insurance are both really important tools. And whether or not it's going to be the most important tool of succession planning will depend very much on your business. And I'll give you an example. If you are in a business where the value of the business really lies in you, because you have the know-how, you have the contacts, you have the goodwill, there's not necessarily a high, what we call book value, but you're really important to the business, such that it would be difficult to sell it or for someone else to take over for you. Having good life insurance is really key to ensuring that you've somehow passed on the value of your life's work to your estate. So either the company or you has a life insurance policy that would be payable to the estate for the value of the business on your death, because it's going to be really hard to find a third party to purchase that business. And you can also start passing on the business both through gifting and buy-in during lifetime. And my advice would be, don't wait. If you know that there are family members who are going to be taking over the business, you can use tools where they're buying in during your lifetime, or where you're gifting during your lifetime. And ultimately, Pennsylvania has an inheritance tax. You can help to reduce that inheritance tax. You can also avoid a situation where maybe family members are inheriting a business that they aren't in a good position to run. So you're intentionally passing on the business during your lifetime to the folks who are able and willing to continue your legacy. And take a peek at these questions quickly. Okay. I'll take this question just quickly before I move on to the next slide, which is, would you consider using an investment banker? I think that very much depends on the size and nature of your business. And if you're looking to bring in investors, what the scale of the investment that you're looking at. I think there's kind of certain thresholds where that would make a lot of sense. Because depending on exactly what that investment and investment structure looks like, you've got a lot of regulatory requirements that you're going to have to make sure that you hit. So I would say that the first step is talking to your attorney, and your attorney should be able to tell you, you need to be working with an investment banker on this to put together the deal, to find the investors, and to structure it in a way, in conjunction with your attorney, that where you're not violating any regulatory SEC concerns with the way you're doing that. So yes, in the right situation, bringing on an investment banker is wise. Okay, a really important aspect to being able to pass on your wealth, regardless of the method, whether it's a sale to a third party, whether it's to family members, whether it's on death, is valuation. You've got to know what your business is worth in order for anyone to be able to buy in, for you to be able to gift it, for you to be able to sell it. And valuations are complicated. It requires, unless all parties are in agreement, or you've agreed in advance in your governing documents as to the value, it's going to require a professional. And it's a very specific job. There are a lot of different methodologies to valuation, and the methodology that's used is going to be industry specific to you. It's a little bit like real estate appraisals. Valuation is often more of an art than a science. So people can really disagree about the methodologies that are employed. And I'll talk a little bit more about that in a moment here. The timing and effective date of valuation is really critical. If you've agreed in your governing documents that the value in 2005 was X, and now we're in 2021, that's probably a stale number, and you're going to have to revisit it. Sometimes businesses, particularly ones that actively have succession planning going on, where there's continuous buy-in from key employees or family members, or there's continuous gifting to key employees or family members, there's an annual or every 2-year kind of valuation. It's an expense, but if the business is of the size that requires it, then it's an expense that's worth it. So as I said, you can always valuation can occur by agreement, where there's either a method or the governing documents should, even if they don't have an agreed value contained in them, they at least should acknowledge a method or an agreement that we're going to get the advice of a third party in order to give us a valuation when the time comes. So and I would suggest you need a professional evaluation. It can be a little bit dangerous to just agree to the value. And frankly, especially on the end of the individual who is selling. If it's your business and you've grown it, it can be really hard not to attach a sentimental value to the business and not to attach a sweat equity element to the business, which may or may not be merited depending on the situation. So it's helpful to have an objective third party tell you, this is what it's worth. Here's how you have to approach this realistically. And sometimes that can be, it can be a rude awakening, but it's a little bit important to be grounded in what your business is actually worth, not just what you think it should be worth. And again, it gets you thinking early. If you've engaged in these kind of valuations early, you can be prepared for that later and not surprised for that later. And if it turns out this is a business that isn't going to be valued as highly as I think that it should be for me to be prepared for retirement or for me to pass on this wealth to my family when I'm gone, that's when these other tools like life insurance and early retirement planning, aggressive retirement planning can become really important, because you can't just rely on the idea that you're going to be able to sell your business for a lot of money when perhaps you just won't be able to. And the sooner you know that about your business and the industry that it's in, the better. In terms of methodology on valuation, the IRS doesn't give a ton of information, but there are certainly factors that need to be considered. Ultimately, what you're looking at with valuation is fair market value. And all fair market value is defined of is what a willing buyer would pay a willing seller. So when it's an arm's length transaction and not under compulsion, what one person will pay for another person's business is its fair market value. It's going to be really industry specific. As I said, didn't finish the sentence. That last sentence should say, intelligent minds may disagree. There's a lot of disputes and even litigation over valuation. So the more specific you can be in the governing documents about the methodology, the better, so that you don't have professionals arguing with each other about what the value should be. Here's some approaches, just so you get familiar with the kind of terms. One is a cost approach. So it's the value of the net equity calculated as the value of tangible assets less the value of liability. A market approach is more based on comparison in the market. So you might be looking at what other businesses in the market are valued, how other businesses in similar market and size are valued. Or there's the income approach. So it's based on the present worth of all future investments that the investment will yield. So you're looking, at future income, and it might be you look at income for a year perhaps, and that ends up being multiplied by a factor over a number of years. So those are three different basic approaches, and none of these is right or wrong over the other. It really depends on the industry that you're in and what the common valuation is for the industry that you're in. Another value that you'll hear is book value. And this is the value of an asset as it appears on the balance sheet, less liabilities. Book value, often is the lowest value that you're going to find. So if you're looking to sell your business, you're not usually looking for book value as being the value, depending on the industry. It doesn't include goodwill, customer lists, or other kinds of intangible assets that oftentimes are what really bring value to a business. It works if a business is steady with little growth. It really does not do a good job of reflecting value for a business that is growing or is about to grow, or a business that has a lot of intangible assets, a business where your talent, your goodwill, your customer list, your know-how, those are where the value of the business is, as opposed to the things that you can actually see and touch. So most of the time, book value is not going to get you your what's deemed as your highest value. There's also a number of adjustments that can be made when you're doing valuations, including minority discounts. So if you've got a business with 100 shares and you have a per value share, so let's say the per value share, just to use round numbers, is $25, but maybe you only own 10% of the company. So because you only own 10% of the company, you don't have any control over decision making. Your value on the fair market would be a little bit less, and there may be a minority discount applied. What that discount is can be greatly debated. So that's and it can be very controversial whether or not a minority discount will or won't be applied, or how aggressively it's applied. Lack of marketability generally. So I can assign a value to this business, but I'm not really going to be able to find a third party to purchase it. So there may be a discount if there's not really marketability, even if my business is super successful because I'm running it. There's not really a buyer for it because the business is me. Key person discount. So maybe if this is a little bit similar, I think, in some respects to lack of marketability. Like if the business is really, if I'm the key person to the business and I'm not being sold with the business because I'm selling the business, then there can be a discount for that too. There's also what's called blockage discount. If there is a market for the interest, but only in little increments as opposed to a big block. So there could be a little bit of a disagreement there, as well as whether or not it should apply. And adjustments, I find they lead to the greatest amount of controversy when you're trying to negotiate a value, because opinions can vary wildly with regard to the appropriate application. There were some Treasury regulations that proposed to reduce the use of valuation discounts because they can be used pretty aggressively, but they were ultimately met with so much opposition they weren't finalized. So I think that tells you that this is an area where a lot of controversy exists in the valuation world. Okay. And here we go. Okay, sorry. I spoke earlier about how important insurance can be as a tool. Life insurance is a really important tool in succession planning because it can be used to pay the estate directly. For example, if there isn't really good marketability for the business, using life insurance can be a really valuable tool there. Or if it allows a key employee to buy in at the time of death. So in your governing documents, there may be what we call a buy-sell trigger that's triggered by death, and it allows a partner or another key employee the opportunity to buy shares of the business at the time of that individual's death. But that might be a really large number and difficult to come up with. So either the key employee or the business can keep life insurance on you so that there is the opportunity for that buy-in at the time of death. You also often see in buy-sell triggers that are activated by death or otherwise that perhaps there's that it's set up to allow someone to buy in over time. So maybe they'll pay 20% upfront and then pay the estate their remaining amount at a certain amount of interest over the course of the next 5 years, for example. And that really depends on what you put into your governing documents and how you negotiate that with your partners. But it's really important to take a look at, and this is where using your professionals like your insurance agent can become really important, to look at who's insured, who owns the policy, and what you're using it for. Are you using it for income replacement? Are you using it to equalize some inheritance? Are you using it to fund stock transfers or interest transfers where a key employee is trying to buy in on a death event? Okay. So in buy-sell agreements, a company may buy insurance on one or more owner to purchase the owner of the interest of the deceased owner, as I just mentioned. And it can also provide a ready buyer for the interest. So it can help to provide the cash to do that quickly. It's an important and essential tool. In terms of the kinds of products that you're looking at with insurance, there's term policies, which will, exist perpetually. There's whole life term policies, which exist for just a term of years. Whole life policies, which exist for the remainder of someone's life. What you often refer to as key man policies. So if you're in partnership with 2 or 3 other folks, you might all have life insurance policies on each other so that your partner has the cash to buy you out or the company has the cash to buy you out. You may also want to think about disability policies. Because if you are the key driver of your business and suddenly something unexpected has happened and you've become disabled, you're not able to operate the business anymore, you haven't been able to put in the time that you need to either save for retirement or to put the business in a position where it's readily saleable, or where you've got key employees who are ready to buy in or willing and interested to buy in. A disability policy can be really important to help replace the income that you're losing unexpectedly. So it can be a smart thing to have in place, and I encourage you to talk to your insurance professional about that. Other kind of strategies, and I've sort of hinted at some of these already, where key employees can either buy in or earn interest over time. Again, remember, if you're earning interest as compensation, you have to assign a value to it because you have to report it as income to the IRS. And you can buy in, structuring it out over a note, or you can gift. And I have to make a correction. The annual gift limit is now $15,000 a year, and there's other kinds of gifting strategies. And you'd want to, carefully talk to both your legal professionals and your tax professionals about setting up a gifting program if that's what you wish to do. There's a tool that you've probably heard of before called a family limited partnership that makes transferring interest within a family a little bit smoother, because you can still control the entity, but you can start bringing your family members in with ownership interests, and they can either be voting ownership interests or passive ownership interests. So you can both pass on control and or wealth through family limited partnerships. They can be really valuable tools. Or you might be looking at an outright sale. And if you're looking at an outright sale, you've really got to talk to both your attorney and your accountant about the tax implications and the legal structure for that. You could do it either as an asset. You could have someone actually purchase the interest of your business. It could be an insider. It could be a third party. You might want to think about seller financing, which is where I'm going to sell you all of the business and you're going to pay it back to me as a note over time. And therefore, you're replacing my income. So I've got income coming in on a monthly basis from this note, but I was able to sell it to a buyer who maybe didn't have the full amount of cash or couldn't obtain the bank financing in order to do it. So it assures that that you can get payments over time. It's really important to talk to your tax planner about the tax implications of a sale. Because there will be a capital gain to you. So you want to try to plan that as best you can, which is one reason why doing sales slowly over time with key employees can be important. You can help minimize that immediate tax impact so it doesn't all hit in 1 year or over the course of just a couple of years. Or you can bring in investors. You can sell a portion of your interests. You've got to have well-drafted agreements if you're going to be in business with a partner, whether that's someone who you've known for a long time or is in your family, or whether that's somebody completely from the outside. I can't say enough how important it is to have well-drafted governing documents if you're going to be in business with anyone else, whether you love them or hardly know them. It's really important to mention too, and I know I'm running out of time a little bit here, and we want to give Grace an opportunity to talk, that all of this business planning is a key part of your estate planning. There has to be coordination with your estate plan and your retirement plans in order to transition your business, because you need to be looking at, do my business plans match up with my long-term wealth management plans? Am I going to have the kind of income stream that I need in retirement? You want all of these things to be in sync with each other. And just as a note on estate planning generally, I will always say this, whether we're talking in the business context or not, it is never a bad time to revisit your wills, trusts if you're using them, powers of attorney, healthcare directives. You're never too young, and it's never a bad time to revisit them. And I encourage you all to do that frequently. I think I have reached my last slide here. So I'm going to take a breath and look at the questions that we've got here. And at the same time, ask Grace if she wants to jump in and add to anything that I've discussed here, or just talk a little bit generally on your sort of best practices for good accounting and business management.
Thank you, Mieke, and thank you, Elaine, too. I'm glad to be able to share my thoughts as an accountant. My mantra is always the importance of keeping good financial records. Good financial records does not mean that you use fancy accounting software. It's more about keeping yourself compliant. A ledger is perfectly fine if that will keep you compliant. I see software as more about efficiency. So when you're going to jump into software, make sure it's something that you know how to use and are comfortable using it. Mieke said this before, a written plan. It's so important. A written plan is much more important than a mental plan. That is what most of us have. I have a mental plan.
Who else knows your mental plan, right? You've got to share it. It's got to be in writing.
It has to be in writing because nobody knows what's in your head, and what's in our head always changes. So it's better to keep it in writing so that somebody can step into it. Mieke did mention that, we don't know. We plan for life, but we don't know how life happens to us. So somebody should be able to step into your business if the unexpected happens. And that's why a written plan, it's important. Number 3, engage professionals. Go with referrals. Interview professionals for a personality fit. I know most of us, a lot of small business owners don't like to engage professionals because they're afraid of the fee. But this is what I say. If the fee you pay, look at the fee you pay as an investment. And it's also a deductible expense. Most of us are competent enough to know what we can and cannot do. So, investing in a professional is almost like investing in inventory or something in your business that you can turn around and sell. You can't sell us, but the guidance we give you is tremendous. You can save a lot in the long run. Generational wealth transfer, that's what Mieke talked about. If you don't engage professionals, you cannot hand off your business. The professional is the one that is going to help you, guide you, put the plan together, help you do the valuations, that you're able to pass it on to your family, sell it, bring in a partner, bring in an investor. So these are all, basic things that I think we should all have. I know it's not easy, but it's worth it. So plan now so that the plan does not get you. That's about all that I would say.
I'm taking a look at some of the questions that are in here, and some of them are really specific, and my answer is going to sound terrible because it's going to say it very much depends on your specific situation, but I'm going to pick out a couple and just answer them right now. One, I think it was Hannah Beard asked, how do you ensure longevity in your in the estate planning when you're picking the people who are going to succeed you? How do you ensure longevity? I think one key way to do that is buy-in. The sooner you let them be involved in running the business, and the sooner you give them an opportunity to be an owner and have really meaningful input into your decisions, that's how you're ensuring longevity. Make it worth their while, and invest. If they have a little skin in the game, it's much more likely to ensure longevity. And I think also, passing on leadership and responsibility roles has to be real and not just kind of in theory. So I think that was a really good question. Another question is it normal to include an act of God clause or something like that in looking at the seller financing option? And this year has made everyone really think about what we call force majeure clauses in all of their contracts. And that would include, I think, any kind of buy-in, particularly where there's a note, like what happens when someone just becomes unable to pay? What do? Circumstances change. Yes, absolutely. In every contract, big and small, people are thinking again about, what do we do when the world stops moving? How do we handle these obligations?
And we do have more questions in the queue. I think some of them have been answered, but just going to start from the top.
Sure.
There's a question from a business owner who appears to be a new business owner in downtown York and also a new resident in the United States. I don't know necessarily whether a citizen or a legal resident, but are there any factors that should be considered if you are new to the US and this process and resources for this business owner?
Well, I think if the question is sort of like, how do I identify the right advisors and professionals
Yes.
to guide me? I think we have a lot of really good resources in the community to be able to do that, starting with YCEA. And I think, connecting new and emerging business owners with professionals is a really important role that you play. So I think that's a wonderful place to start.
I agree. And I think, part of the US tax system is if you live in the USA, you pay tax. That's the thing. Or even if you live outside the United States and you have investments in the US, you pay tax. So if you're looking more at the tax structure, it's something that you are going to be subjected to. So definitely joining the YCEA. Downtown Inc. puts out a lot of information for small businesses.
Yeah.
Using downtown.
And what you don't know can hurt you, which is, I think, is why it's important to engage professionals and gather as much, do your homework and absorb as much information as you can, but engage professionals to help you identify the things that you don't know, especially if you're new to the community, if you're new to the United States. There's a very different way of doing business than there is abroad in terms of what's required of you.
Right. And I think that's a really important statement, Mieke, that what you don't know can hurt you in this case. And trying to do the cleanup is often more difficult than planning appropriately during the process. And I know, Grace, you alluded to that as well. So I want to invite, as you said, anyone who's participating has more questions to contact us through the YCA Downtown Inc. And we can certainly connect you and get you either connected with a business mentor and also some upcoming workshops that we have. We actually have a couple coming up that are listed on ycapa.org that I think would be helpful, and one on funding, small business funding, which is our next business series workshop on May 19th. Let's see, I think we've worked through a lot of the questions. There's one here: would the income approach be the best to value my client list as I'm looking to sell? How do you value your client list?
Yeah, I think, that's going to be, gosh, it really depends on your industry kind of a question. But I think, I think it would either, it would probably look something more like that, or sort of the approach where you're looking at market and how you might compare it to others in the market. It so depends. I'm hesitant to say yes or no without knowing more. And I talked a lot about valuation. I don't do it or pretend to know how to do it. That's not in an attorney's wheelhouse. That's very much, and it's a really specialized, and it's, an accountant who is specialized in valuation who's going to be doing that.
Yeah, I agree. It is very specialized, and you have certifications for that. So it's something that I highly recommend. Get a professional who's certified in doing that.
Yeah. The extent of my knowledge on that is that I can identify them and understand them and talk about them, but I can't do it for you.
So again, having those trusted advisors and partners to help you grow your business are definitely key. So we are at the end of our time, and I don't want to go over, I know everyone probably has a really busy day, so I just want to say thank you again to Mieke and Grace for just a really informative dialogue. If you want to watch the replay, it was a lot of information shared. It's going to be available this afternoon on downtownyorkpa.com, and we will have the presentation available too. So I learned a few things. I'm going to rewatch it myself, and we invite you to enjoy the replay and share it with other people who you think would find value in the content. Save the date for our next business series, which is May 19th at 8:30. We'll have Greg Verbowski, Vice President of PNC, and also Suli Pinos, our Director of Business Solutions and Innovation with YCEA, and they'll be talking about funding opportunities for small businesses. So again, thank you both for your time and the great information shared this morning. And thank all of you for joining us for the business series, and have a great day.
Thank
Thank
you.
you, everyone.
Thank you.
Thanks for having me.
Thank you.
Take care. Bye-bye.